What if I told you one of the biggest financial traps in America is sitting in the driveway? It looks normal. It looks necessary. It looks like transportation. But for millions of Americans, the car payment has quietly become one of the biggest reasons they cannot build wealth. A car is supposed to give freedom. Freedom to work, freedom to travel, freedom to take children to school, freedom to live daily life. But today, many people are not driving toward freedom. They are driving deeper into debt. Welcome to NextGenFinance, where we break down money, business, the economy, and financial psychology in the simplest way possible. Today, we're uncovering how car payments are keeping Americans broke. The first thing to understand is this. In many parts of America, a car is not optional. Public transportation is limited in many cities and suburbs. Jobs may be far away. Grocery stores may not be nearby. Families need mobility, so people need cars. But needing a car does not mean the car system is harmless. The problem starts at the dealership. Many buyers do not focus on the total cost of the car. They focus on the monthly payment. The salesperson asks, "What monthly payment can you afford?" That question sounds helpful, but it can be dangerous, because a lower monthly payment can hide a longer loan, more interest, and a higher total cost. People think they are buying affordability, but sometimes they are buying years of debt. The second problem is depreciation. A car usually loses value over time. That means people are making payments on something that is becoming less valuable every month. This is very different from an asset like a good investment or real estate, which may grow over time. A car may be necessary, but financially it often behaves like a liability. It takes money through payments, insurance, gas, maintenance, and repairs. And it usually loses value. That is a dangerous combination. The third problem is interest. When car loans have higher interest rates, the real cost becomes much bigger. A person may look at the sticker price and think they understand the cost, but the true cost includes interest over the life of the loan. And if the loan is long, the buyer may pay much more than expected. This is how a car becomes more than transportation. It becomes a long-term financial commitment. The fourth problem is insurance. Many people only think about the car payment, but insurance can be painful too. Car insurance has become a major expense for many households. And depending on the state, driving history, vehicle type, and coverage, the bill can be shocking. So the buyer may think, "I can afford the monthly payment," but then insurance arrives, then gas, then repairs, then maintenance. And suddenly the car costs far more than expected. The fifth problem is repair risk. Cars break. Tires wear out. Brakes need replacement. Engines have problems. Batteries die. One unexpected repair can destroy a monthly budget, and if someone does not have savings, they may use a credit card to fix the car. Now the car problem becomes credit card debt. This is how financial traps connect. A car repair creates debt. Debt creates monthly payments. Monthly payments reduce cash flow. Reduced cash flow makes it harder to save. And without savings, the next emergency creates more debt. The cycle continues. The sixth problem is status. Cars are not just transportation in America. They are often identity. People feel judged by what they drive. Social media makes it worse. Luxury vehicles, big trucks, new SUVs, and expensive cars become symbols of success. But looking successful is not the same as being financially secure. Many people drive cars that impress others but weaken their own finances. A car can make someone look rich while keeping them broke. That is the hidden danger. The seventh problem is negative equity. This happens when someone owes more on the car than the car is worth. Then they want to trade it in, but the debt follows them into the next loan. Now the new car payment includes old debt. This can become a nightmare. People move from one car loan to another, carrying debt forward every time. They are not escaping the problem. They are rolling it into the future. So what can people do? First, focus on total cost, not just monthly payment. Second, avoid buying more car than you need. Third, consider reliable used cars instead of chasing new ones. Fourth, understand interest, insurance, and maintenance before buying. Fifth, avoid long loans that keep you trapped for years. Sixth, build emergency savings for repairs. And seventh, remember that a car should support your financial life, not control it. The truth is simple. Cars may be necessary, but car debt can be dangerous. A smart car purchase can help you work and live. A bad car purchase can trap your paycheck for years. If this video opened your eyes, subscribe to NextGenFinance for more powerful videos about money, business, the economy, and financial psychology. And remember, the car in your driveway should take you places, not take away your future.